Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW24 traders, and our website is www.stochastic-markd.com, www.24alienwave.com, www.dayprotraders.com. The title of this video is Gap Trading Like a Pro, Step 3. Gap Trading Like a Pro, Step 3. Let's get started, okay? At this stage, okay, traders should be able to know, all right, the market participants that creates, okay, price gap actions, all right? And also, traders should be able to know or recognize or identify the factors that can force a financial instrument to gap up and to gap down. All right. So if I ask you the question now, okay, what are the market participants that can create a gap in the financial market? If you do not know, if you are not sure, all right, if you want to go 50-50, if you feel like phoning a friend, all right, in that case, you need to watch the first part of this video that we call Gap Trading Like a Pro, Step 1, all right? If I ask you another question, all right, which is this, all right, what are the factors behind price gapping up and price gapping down, all right? So you are taking your exam, I ask you now, I say, my friend, what are the factors behind price gapping up and gapping down? All right, if you are not sure, all right, if you want to go like 50-50, if you feel like a phoning a friend, all right, if you don't know, all right, I will recommend to you to watch the video that we call Gap Trading Like a Pro, Step 2, all right? Now, let's get started with part 3. This is part 3 of this series of video about gap trading like a pro, step 1, 2, and 3. In step 3, we will be talking about different types of gap. So all the gaps you see here, this is Apple stock today. In fact, today you see here on the 28th, it's your live chat now, 28th of October 2015. The time in London is 38 minutes past 1 p.m. In New York, 9:38. So you have to understand that in London, Sunday gone, the clock went back, all right? So New York did not put their clock back so far. So the difference between the time in London and the time in New York is 4 hours instead of 5 hours. So that's why you see here, 1:38 in London and 9:38 in New York. The market is now open in New York. So this is a live chat. So as on the 28th of October today, we can see that Apple stock gap up. You see, it gap up today. All right. See here, there's a hole here. Are you seeing it? Okay. Here it is. Okay, it gap up from the zone of 11471 and rush all the way up to 11754. My friend. So there's a huge bullish gap. It gap up. All right. So here it is on. On the 26th, it gapped down. Here it is, it gapped down. See here? The price was here. As the market opened, it was at 119.06 and it gapped down. Okay? At 118.12. Here, on this particular day, on the 22nd of October 2015, you can see that it gapped up from here all the way up here and then continue to go up. So this is a bullish gap here. Okay, this section here, there's a hole, and here it is, there is also a gap again. Here, price gap down, it gap up here, it gap down here, and today, again, on this chart, you can see that it gap up again. All right, there's a high chance it may go up here before coming down. There's a high chance it may continue to go up a bit before coming down. So, let's go back to our main subject, talking about the gap trading like a pro, step 3, all right? There are different types of gap, so we want to know which one. So typically we can say we have a bullish gap and a bearish gap, but that is not enough. There are more to gap than that, okay? We have what we call, okay, opening gap. Okay, the opening gap, you will see usually in Forex. So the price is consolidating during the Asia session. all right? For Forex traded, price continue consolidating, probably on a 10-minute time frame consolidating, okay? And then London is open, all right? And the price may gap up. This is what we call the opening gap. Market is open and the price gap up. Or a stock or a commodity was consolidating during the last hour before a market is about to close, and the following day the price gap up. This is opening gap. Now there's another thing that a lot of traders do not know, all right? The opening gap is also the gap that we usually see during the first Elliott wave. In fact, I believe the correct definition of the opening gap is the gap that occurs during the first Elliott wave. So this is one type of gap, the gap that is occurring at the early stage of a trend is the opening gap. Whether it's a bullish trend or a bearish trend, the gap that we see at the early stage of a trend, this is what we call the opening gap. All right. So apart from market being about to open, as I show you for the Forex, for the stock, general rule that you must not forget: the opening gap is the gap that we see at the earlier stage of a trend, usually during the first Elliott wave. So that's why you see consolidation, boom, gap up, and it continue. All right. I will link this video to another video. So I'll put here. Hold on, please. Let me note it down so I don't forget. All right. I will link this video to a video that I recorded recently. Where are we? 1 second, please, my friend. All right. I will link it to a video that we call How to Trade the First Elliott Wave Gaps Like a Pro. Okay. How to trade the first Elliott Wave gaps like a pro. Okay. All right. Okay, link to first Elliott Wave gap like a pro, so you may understand the opening gap. If you watch that video in the description section, okay, you may understand more about the opening gap and how to trade it. The next type of gap that we have is what we call the continuation gap. The continuation gap is, generally speaking, my friend, is the gap that will occur during a trend, in the middle of the trend. Now, so talking about the time or the place of the opening of the continuation gap, we are likely to see the continuation gap when we reach the middle of the trend. They occur in the center of a trend. So for us that understand Elliott wave, for traders that are learning to understand the Elliott wave, for all Elliott wave practitioners, the continuation gap, the best place for the continuation gap is during, okay, the third Elliott wave. So apart from that, my friend, so that's why I'm using the word like this. If you don't know about Elliott wave, that the continuation gap usually takes place in the middle of a trend, at the midpoint of the trend, as the trend, the bullish momentum is at its highest point, is strong. All right, it's now clear for everybody that it's a bullish trend. We may see a gap, all right, or it's now clear to everybody the bearish trend is maturing, and the market is saturated by the bear, okay, and we are in the middle of a bearish season. We are likely to see price gapping down. This is a continuation gap. I will explain to you more the characteristic of the opening gap, the continuation gap. Okay, so hold on, please. We are continuing with this recording now, so stay with me and breathe in and breathe out like myself. Okay, so continuation gap likely to take place in the middle of the trend. All right, but so the general rules is this. All right, suppose we have a pattern like this. So I'm going to draw a pattern. So just look at it like this. Okay. All right. Okay. All right. So we are likely to see the opening gap. So we practice from the 1 to 3 like this, the opening gap at the early stage of the, so if we have a pattern like this, okay, so we know that something, okay, just think of it, like something move down like this, and move up like this, and come down like this. This is the terminus. So talking about like a train, this is the starting point of the train, this is the end of the train. Or a motorbike starting from here, come down, go up, come down. So the opening gap will happen at the beginning of the train, okay? Beginning of the train, early stage of the train. Okay? The continuation gap is likely to happen in the middle of the train, somewhere here. Okay? Continuation gap in the middle of the train. Alright? And the third gap is what we call the exhaustion gap. The exhaustion gap will take place almost at the end of a trend. So if I'm talking about this pattern like this, 1, 2, 3, the exhaustion gap is likely to happen somewhere here. So when we know, for instance, a pattern, right, like a zigzag pattern or a flat correction pattern or the C part of a zigzag pattern, we know that the exhaustion gap is likely to take place, all right, during the C wave of the flat correction. All right, the last part of the pattern, that's where we are likely to see the exhaustion pattern. So the exhaustion gap will take place almost at the end of a trend. And the exhaustion gap is likely to be filled. The opening gap also is likely to be filled, partially be filled. Now, I don't want the video to be too long because there is another series of video that we will be recording, all right, which is we will be calling how to trade gap like a pro, part 1 to 4, all right. So I don't want this video to be long now, so I want to highlight the different type of gap. This is the purpose of the video. But we will be recording another series of video that we will be talking about how to trade gap like a pro, part 1 to 4, all right. All right. So the opening gap, the characteristic of the opening gap is that the opening gap is likely to be partially filled. What do I mean by that? Okay. So if we have an opening gap, suppose this is an opening gap, okay? This hole here is an opening gap. The price may pull back to the 50% to the middle of the gap. So price may go up, as you see. Suppose this is the opening gap, price gap up from here to here. Price go up. If this is the opening gap can be partially filled. The healthiest, okay, opening gap are likely to be filled only partially. So price may pull back into the 50% and 61.8% of the opening gap and before resuming the trend. In some cases, my friend, this is not an exact science or theory, all right, my friend? So don't take it like a 1 + 1 = 2. Now, I know that, okay, some traders think that way. That's why I'm saying this now. Don't think that way, okay? If you are that sort of person, you are a mathematician, 1 + 1 = 2, that's not why it is. It's not always like this, okay? Sometimes, but the point I want to make, generally speaking, the opening gap is usually partially filled. The price may go back down to the 50% and 61.8% Fibonacci retracement level of the gap, okay? All right? But sometimes the price may go and fill the gap. What we remember the gap, the price will go in completely and cover the whole session. We return back into the session, the 100% session of the gap. It's what is meant by the gap being filled. Price returning into the session of the gap and covering the whole session of the gap. That's what we mean by the gap being filled. So this is the characteristic of the opening gap. The opening gap is likely to, so if I ask you the question now, what are the characteristics of the opening gap? The opening gap is likely to take place at the beginning of a trend, of a pattern, at the early stage of a bullish trend or bearish trend. We usually see it at when a market is open, okay, and we see a consolidation, okay, before that. This is likely to be an opening gap. But remember, there are more to this. So at the beginning of a pattern, all right, we are likely to see at the early stage of a trend, we are likely to see an opening gap. And the opening gap is likely to be filled only partially, okay? All right? So you want to ascertain that it's truly opening gap, all right? And, okay, if it's opening gap, there's a high chance that the price may return back into the session, but only partially, okay? The next gap that we call the continuation gap that usually takes place in the middle of a trend, at the center point, at the midpoint, when the momentum is at its highest level. So we reach the middle of the trend, all right? So you will notice that traders are trading area wave, the third area wave. The RSI is overbought and remain overbought for a long period of time during the third area wave. Don't sell because of that, okay? All right, I'm shouting to get your attention, all right? And if it is a bearish third area wave, the stochastic may remain oversold for a long period of time, or the RSI may remain oversold for a long period of time, or the CCI may remain oversold for a long period of time. That's the optimum level to sell, not to buy. Though these indicators are telling you that it's oversold. It's not oversold yet. But you are at the midpoint of the gap. At that point in time, when all the oscillators are still oversold, okay, you may see the price gapping down. This is what we call a continuation gap. A gap that is occurring in the middle of the trend when the momentum is at its peak. So oscillator are oversold, okay, but if we are in the middle of a bearish trend, boom, it gap down. Now, the characteristic of the continuation gap is that these gaps are not filled. So what do I mean by that? So you see here, it gap up from here, Apple stock, it gap up from here to here, and just continue to go up, okay? And then you won't come back here, all right? You just go up, you go up until the trend is finished before the price will come back into the session of the continuation gap. Sometimes it may not even touch it. You may see some gap that remain in place, not filled for even years, months. All right. So remember that continuation gap are not filled instantly. So one of the characteristics of the continuation gap, they are not filled on that day. Okay. It won't be filled on that day. Okay. Or sometimes it won't be filled on that during that week. It won't be filled sometimes during 1 month or even a year. All right, because these are long-term gaps, and the long-term gaps are created by fundamental traders, hedge funds, big financial institutions, mutual funds. You remember the gap trading like a pro part 1, market participants that create a gap. So remember, the continuation gap are usually created by the fundamental traders that are checking the fundamentals. And they also create the opening gap sometime, okay? Most of the time, the opening gap are created by the hedge fund, the bank, and the mutual funds. Talking about long-term, okay, trend, okay? Long-term trend, beginning of a long-term trend, the opening gap usually are created by the fundamental traders. All right? It makes sense? All right, okay, let's continue with our recording, all right? So the continuation gap should not be filled, okay, quickly, all right? It usually takes place at the center point, at the midpoint of a trend, all right? For area wave trader, usually during the third area wave, or generally speaking, during the midpoint of a pattern. And it's not filled quickly, okay? The next type of gap is what we call the exhaustion gap. Apart from the exhaustion gap, we have other 2 types of gap, which are called speculative gap and long-term gap. I'll come back to that. So let's talk about exhaustion gap, price gapping up, price gapping down. Is it an exhaustion gap? Okay, so exhaustion, all right, is a gap that will occur during the last part of a trend. So usually during the 5th area wave. So we know the trending first wave, second wave, third wave, fourth wave. The 5th wave is the last lap or the last part of the multi-wave, the last part of the trend. We are likely to see the exhaustion gap during the 5th area wave. Talking about the exhaustion gap, I will also put a link in the description section talking about the 5th wave exhaustion gap, okay? So check it out in the description section. All right, if you want to know more about exhaustion gap, check the video that we call, let me tell you the exact title, how to understand and master the fifth area wave gap like a pro by 24 area wave, okay, YouTube channel, okay, how to understand and master the fifth area wave gaps like a pro by 24 area waves YouTube channel. Check out the description section. So the exhaustion gap usually will take place in the last session of a trend, okay, the last part of a pattern, all right, when a trend is about to close, all right. So, for instance, if you are in a downtrend, okay, the fifth bearish trend, during the fifth bearish trend, we are likely to see an exhaustion gap. My friend, the exhaustion gap is the last gap. The first gap is the opening gap. The second gap is the continuation gap. And the third gap is the exhaustion gap. And the exhaustion gap is likely to be filled very quickly. All right? Is likely to be filled very quickly. So, if for instance, suppose you were here, okay? Here, suppose you were here in this session here. Suppose, okay? Suppose, okay? You were here. In my view, I think this is okay, exhaustion gap. We will see. I may be recording another live video today to check this out. Okay, so suppose you were here. I don't want to divert your attention to something else. So suppose you were here and the price gap up from here to here. All right. So we are on the 30-minute charts. Okay, and then on the same day, you see that the price, okay, and the price change direction and fill the gap and come back down on the same day. That will be an exhaustion gap. But the key point you want to understand about the exhaustion gap, where and when the exhaustion gap usually take place. For traders that understand area wave, it usually takes place during the fifth area wave. All right. There are more to this because we will be recording more video about gap trading to explain to traders how to trade gap like a pro. That will be another series of video that we will be recording very soon. Okay. The exhaustion gap is usually filled. The price will quickly go back into the section of the gap on that day or during that week or on that month or during that month or that year. All right? It doesn't last, it doesn't take long before the financial instrument go back into the section of the gap. All right? So for instance, like today, you see that Apple stock gap up from here to here. All right? So the gap, my friend, is from here, where I place my vertical line, my horizontal line, my blue horizontal line, and here it is. All right? If the price filled completely, okay? One second. If the price fills completely the section of the gap today, this will be what we call, okay, a kind of exhaustion gap. Okay, exhaustion gap will be filled on the day or during the week or during that month. The price will fill the gap quickly. Now, remember that the opening gap can be also filled, but partially most of the time, but sometimes can be completely filled. But the exhaustion gap usually is completely filled. 90% of the gap, 90% of the time, the exhaustion gap will be filled 100%. The price will cover completely the section of the gap. The opening gap, 90% of the time, it will be, okay, partially filled. But remember, it's not always like this. That's why I say to you, it's not a science, okay? Sometimes the opening gap can also be filled completely, but rarely what we see very often, the opening gap is partially filled. So talking about the different type of gap, we have the opening gap, the continuation gap, the exhaustion gap. The opening gap will take place at the beginning of a trend, the continuation gap will take place in the middle of the trend, and the exhaustion gap will take place at the end of the trend, almost at the end of the trend. So opening gap, for traders that understand area wave during the first area wave, continuation gap during the third area wave, exhaustion gap during the fifth area wave. But if we go a little bit deeper, talking about market stable data, okay, the continuation gap will take place at the beginning of a pattern, of a move, all right? Okay? And a continuation gap will take place in the middle of a pattern or in the middle of a move, all right? Now, am I making myself clear? The exhaustion gap will take place at the end of, a trend, a cycle, all right, or a pattern, all right? So that's why I said to you, if you have a pattern at the 1, 2, 3, and ask you where the opening gap is likely to take place, somewhere at the beginning here, opening gap somewhere in the middle here, okay, and, exhaustion gap somewhere at the end. So there are many type of patterns in the market: the 13 specific area way pattern, the Fibonacci pattern, the normal chart pattern. So where and when can we see the opening gap, the exhaustion gap, and the continuation gap? Now you will be able to answer those questions if you know other patterns like the flag correction pattern, the zigzag pattern, the Fibonacci pattern, the butterfly pattern. Where and where can we see the opening gap, the continuation gap, and the exhaustion gap? You should be able to answer those questions now. The opening gap is likely to be filled partially most of the time, but not always. Okay, the continuation gap cannot be filled automatically on the day or during the week or during the month or during the year. It's not filled straight away. The exhaustion gap are usually filled straight away, on the day, during that week or during that month. Depend. Now, there are other type of gaps that I want to talk about, The speculative gap. I want you to stay focused because I didn't see this on the internet a lot. The speculative gap, as I explained to you in part 1, gap trading like a pro part 1, are created by the speculative market participant, high frequency traders, scalpers, High frequency traders, scalpers, will create a speculative gap. The speculative gap can appear usually on the 5-minute time frame, on the lower time frame. Very often you see on the lower time frame. So price gap up, beginning of the market, and then people say this is the opening gap. But these are not opening gap. But though it's taking place at the opening bell, so people see consolidation, and then price gap up, and they say this is the opening gap, And they say, this is the gap during the first wave. That's exactly what I just said. But no, some of them are not at the beginning of a trend. No trend is about to begin. The price just gap up. These are speculative gap. And speculative gap are likely to be filled on the day. Have I made myself clear? All right. So apart from the opening gap, the continuation gap, the exhaustion gap, we have what we call the speculative gap, when a stock or a commodity or currency pair just gap up the following day, and people think it's the opening gap, it's a blah blah blah, it's a continuation gap, it's a exhaustion gap. Most of them are just a speculative gap, and they will be filled. So what usually take place? These are high frequency traders. These are scalpers that are using trading software, computer tradings, computer trading, automated trading system, I just place a trend and, price gap up, boom, up. Economy news just happened and the price gap up, These are speculative gap. And very often this type of gap can be filled on the day straight away, all right? Usually we see them on the lower time frame and they don't last. And it's like it looks to me is one of them again. Either it's exhaustion or speculation here. We will see if we form an island pattern, that will be an exhaustion gap. All right. So we will see. All right. Now let's move on. So this is what we are talking about. Speculative gap created by high frequency trading, scalpers, gamblers, all right, you name it. All right, can be filled on the day instantly. These are speculative gap, short-term gap. This is what we call is short-term gap. Speculative gap are short-term gap. They don't last and they are just market noise. Boom, it gap up for somebody place a trade to buy, or it gap down because somebody just sold it and it crumble under the pressure, so to speak. All right, these are speculative gap. We also have long-term gap. When a stock gap up big time, all right, usually these gaps are created by the fundamental traders, and it can also due to earning news. When a price gap up, due to earning news. So, for instance, a financial instrument that no one wants to buy, and the next day just gap up because suddenly they exceed the analyst forecast. Gap up, and everybody say, what? This stock They are making a lot of money. This business is making a lot of money. And everybody say, buy this stock for me. And the stock just going up, going up, going up. These are long-term gap. The price will continue to go up and just continue to go up, okay? And that gap may remain there for months, for weeks, even for years. These are long-term gaps. And long-term gaps are created by hedge funds, big institutions that are buying and hold or selling and hold. So they buy and they don't want to move. And they are protecting their position and they don't want the price to go back to their opening price. So the price gap up and just going up. People say it's going to come back and fill the gap. No, the price just going up, going up, going up, going up, going up. And this is a long-term gap, and it will take some week, month, and year, even year sometime before the gap, the price will return back into the section of the gap. All right? Okay? These are long-term gap. Some exhaustion gap can be long-term gap when a bearish season, a bearish cycle is about to begin. So, for instance, you see it now, we see in 2007 to 2009, we have the bearish season. So you may see some top make gap up at the beginning of the bearish season, gap down, and people say it's going to fill the gap. But it's just going down. You won't fill that gap for many years until the bearish season is finished and before the stock will return back into the section of the gap. So the long-term gap can happen at the beginning of a strong trend or at the end of a strong trend. What we meant by beginning of a strong trend, end of a strong trend is the same, in fact. So the beginning of a trend, okay, is the end of the previous trend most of the time. So a cycle has ended, okay, a new trend is about to begin. In normal condition, it's not always in normal condition. A cycle has ended. 2009 is the end of the bearish season, and a new bullish cycle has begun in 2009. Yes or no? So we see a bearish season began in 2007 to 2009. As the bearish season has ended, okay, we have a bullish cycle. So we can talk about cycle. The long-term trend usually you can see a long-term gap at the beginning of a cycle. It's either a bullish cycle or bearish cycle. Okay. This is the end of this video about gap trading like a pro, step 3. We were talking about different types of gap, okay? The opening gap, the continuation gap, and the exhaustion gap, the speculative gap, and the long-term gap, all right? The opening gap usually takes place at the beginning of a trend, of a pattern, all right? The continuation gap usually takes place at the center, at the midpoint of a trend, or during the third area wave for area wave traders. The exhaustion gap will take place at the last part of a pattern, during the fifth area wave, almost at the end of the trend. The exhaustion gap is usually created by, the last players. Remember in step 1, we were talking about the last players and the first players. The exhaustion gap is usually created by the last market players that join the trend at the last minute. Check part 1. Okay, the opening gap is usually created by the first market players. Check gap trading like a pro, step 1 to understand the first market players, okay, the first buyers, the first sellers. All right, we also have what we call, the speculative gap created by high frequency trading, and scalping can create what we call speculative gap. We also have long-term gap that are created at the beginning of a new cycle. Okay, the opening gap can be usually is partially filled. The continuation gap is not filled straight away. The exhaustion gap very often can be filled on a day, on a week, or during a month, or during that year. Okay, the speculative gap most of the time should be filled. Speculative gap. Long-term gaps can remain in place for weeks, months, even years. All right. This is the end of this video, and we have a link for a video talking about 2 video links in the description section. Check it out. Okay, this will allow you, to understand, gap trading. Okay, talking about how to trade the first area wave gaps like a pro. Okay, check it out in the description section, and also how to understand and master the fifth area wave gap like a pro, also in the description section. Okay. If you like this video, please give us the thumbs up. If you dislike it, please give us the thumb down. All right. If you love this video, feel free to share it on Google+, on Twitter, and also on Facebook. If you love our videos, our recordings, feel free to subscribe to our channel. There is a link in the description section. Hit the subscribe button, and you become our friend, and you can watch tutorials like this. Okay. If you have any question, put it in the description section. Have any suggestion, put it in the description section. No spamming, please, my friend. All right. If you want us to record another video or talk about a specific aspect of gap trading, put it in the description section. And in due course, we'll record another video that will answer your questions. All right. We are the GSTW24 traders talking about gap trading like a pro, step 3. This is the end of this series of video about gap trading like a pro, step 1, 2, and 3. We recommend to traders to watch part 1, part 2, part 3, so they may understand, gap trading like a pro. All right, we will be recording another series of video about, how to trade gaps like a pro, part 1 to 4. So stay tuned and subscribe to our channel. We will also be talking about how to combine gap trading and market geometry like a pro, how to combine gap trading and Fibonacci like a pro, question and answer session for mastering gap trading. Until the next time, enjoy yourself and be very happy. Speak to you soon.